Our next panel discussion on the main stage looks at the theme of retirement and what the pandemic has done to work life and the life after work. As us Kiwis know, for our work-life balance and a secure retirement is a key factor embodying this balance. And our expert panel will weigh in on the topic and share their predictions and advice for a secure future. Just checking that everybody's ready. Ladies and gentlemen, please welcome to the panel our facilitator, Jack Tame, and our panellists.
Kia ora te whānau, thank you for being with us this morning. This should be a fascinating conversation. Don't forget, we're still running questions throughout the morning, so if you'd like to submit some for our panellists, please do, and I'll endeavour to get to them over the next 45 minutes or so. It's funny, in a sense, I think COVID-19 has been an accelerator. So for many people, it has been an opportunity to step back and take some perspective in life, to consider what they value, to consider where they're headed. For some businesses, it's been an opportunity to grow. For some businesses that perhaps didn't have the legs, they've met an end sooner than they might have otherwise. For relationships, it has been an accelerator. I think many of us who spent a long time in lockdown with a loved one will have emerged feeling either closer or further apart. But it's interesting, like I say, it has been an opportunity for many of us to pause and consider what we value. Instead of just bumbling through life, it's been an opportunity to say, what do I really want in my life and how do I get there? And I think for many Kiwis, considering how their latter years might be lived, this has never been more pertinent. I think back to when my grandparents reached retirement age, they had very different experiences. One of my grandparents was a mechanic. He worked until the day he turned 65. That was it. They gave him the watch. He pulled sticks, and he never worked another day in his life. My other grandparents valued work in a different way. They enjoyed their work. They wanted to continue working. But as tenured university professors, once they hit the age of 60, they weren't able to continue working in their previous institution. It's funny, when we think of retirement, I think many of us have a perhaps too narrowed, cliched view of what retirement should be. We think of cruise ships or of days spent on the golf course. But of course, no one retirement, for want of a better term, is the same for different people. COVID-19 has been an opportunity for many New Zealanders, regardless of their age, to consider how they might spend the latter years in their life and to consider whether or not they're in a financial position that will help them to achieve the kind of life they want. So without further ado, I'm going to talk you through the panel this morning, and I'm going to ask each of our panellists to introduce themselves. We've got a bit of a mix this morning in that our panellists are here, and we have some panellists joining us digitally as well. So first of all, Retirement Commissioner Jane Wrightson. Kia ora, good morning.
Kia ora, Jack.
Can you tell us about your areas of interest and focus in this space?
There's twofold areas of interest for the Commission for Financial Capability, and one, of course, is the financial capability work we do to prepare New Zealanders to think better about the future and to think better about the retirement that they need to plan. And as you know, planning for this kind of stuff is a little bit like going to the dentist. You tend to put it off, and it's really important that you don't. The other side of the work we do is in the retirement policy space, which we're doing deeper thinking around at the moment, particularly around crunchy issues like, is it really an issue that the age of super stays or moves? Is it really an issue about if and how the country can afford superannuation? All that stuff. And I think what the New Zealanders are missing at the moment is independent and trusted information where they can make their own minds up. I think that's our job.
Fantastic. Tēnā koe, welcome this morning. Rob Everett, CEO of the FMA. You might be familiar to some of our viewers this morning. Can you just tell us about your areas of interest in this space?
Yeah, so the FMA is both a markets regulator and a conduct regulator, so we are focused on encouraging and creating an environment where people trust their financial markets, where they trust their financial services provider, and they have the confidence to engage in those markets and buy those financial products. So our focus is on working both with providers of financial services, but also the people that buy them, the investors and the consumers, to create that environment where there is a confidence that people will be treated well, that they'll be treated fairly, and that the industry understands the expectations that we as a regulator, but also the consumers have of them.
Fantastic. Hoki mai, welcome. Susan St John, who's the Director of the University of Auckland Retirement Policy and Research Centre. Kia ora, Susan.
Kia ora.
Can you tell us about your areas of interest in this space?
Well, working in the centre, which I think perhaps should be rebranded given that today we're discussing retirement being dead, Retirement Policy and Research Centre may be a bit dated. Our interest is in the areas that Jane has talked about, the policy issues, the design of our basic state pension, the way in which KiwiSaver helps people to have that additional extra in retirement, issues around decumulation, how do people use their lump sums once they reach retirement.
Fantastic. Thank you for being here this morning. All right, Ryan Bessemer, CEO of Trustees Executors. Kia ora.
G'day. So Trustees Executors are very much like the FMA, but also others on the panel. We're a supervisor, a regulatory supervisor in the managed investment scheme and KiwiSaver space. So really what that means is we take care, in terms of a frontline regulation, the managers that look after KiwiSavers. And on top of that, we also have an administration business that actually looks after about a quarter or to a third of all KiwiSaver in the country from a member perspective, and we manage those member records. As a supervisor, we work with the managers to be able to engage more effectively with the investors in the funds, and we have a fiduciary duty to the actual members in the funds to make sure they're getting the outcomes that they need. To me, there's a number of really big questions out there that need to be asked around retirement in the country, and particularly when it comes to KiwiSaver is KiwiSaver enough for retirement? And do we need to make some changes around the rules to KiwiSaver to be able to change with the economic times? And on top of that, is the plain generic KiwiSaver product enough for what the market needs right now? So what we're looking to do is really lobby on behalf of the investors in the funds to be able to do more in terms of that KiwiSaver space and to make sure that there's ample retirement savings for the future.
Fantastic. Tēnā koe, welcome. We'll go to our digital guests now this morning. Will Burkett, who's the Retirement Innovation Leader at Mercer. Kia ora.
Good morning, everyone. Thank you. My passion is broader than just financial security. When you think about a person's well-being, financial security is a critical panel, but there's other aspects that are non-financial or are contributory to financial security. And so some of the more specific areas I'm focused on, other than just retirement incomes and savings, is an ageing workforce and helping employers and employees be more inclusive of experienced workers, as well as thinking about ageing care needs, supporting seniors and their family carers prepare better. And then I guess some philanthropic, combating social isolation for elders in our community with corporate volunteering. So that there's some examples of how they're all tied together, helping our aging society.
Wonderful. Thanks, Will. And finally, last but not least, the CEO of Core Data, Andrew Inwood. Kia ora.
Kia ora, and thank you very much for having me. A little bit like Will, my approach to retirement is somewhat more nuanced. I'm very interested in how consumers, and by that I mean the population, are behaving as they approach retirement, they move through retirement, and they move towards their sort of second or third phase of their working or retirement lives. Retirement's complicated. It's not the same for everybody. Not everyone has the same financial position. They don't have the same emotional state as Will was talking about. And understanding how people move through that intelligently is the most important thing that I can think of that's running around in society at the moment. Helping people in New Zealand have their best possible retirement, that's a phrase that we're really focused on at Core Data, is something that we're working hard to understand, and we're working hard to understand what the drivers are. Money is one part of the driver, but it's not everything. making sure that we understand and unpack all the elements of the best possible retirement is a continuing focus for us.
Fantastic. Thanks for being with us, Andrew. The way this will work is I'll throw out a few different subjects over the next 40 minutes or so, and if any of you have something in particular you'd like to say, just make sure I know, and I'll try and get there as quickly as possible. I think I'll pick up on a point that Andrew just made then. Retirement is a term that we throw around with gay abandon, but actually it means all sorts of different things for different people. So Jane, perhaps we can start with you here. What do you see retirement as being in 2020, and on the path that we're currently on, what do you see retirement as being in the next 10 or 20 years?
It's impossible to talk about retirement now, isn't it, without referring to COVID. And what COVID has done is thrown a lens on what was already happening and started to speed things up. So retirement is a trajectory. There's no such thing, I think, as work, not work. There's no such thing as hard and fast rules. It's a very personalised decision, as I think Andrew just said. The most important thing to think about, I think, is how we can, as a country, provide older people in particular with a system that enables dignity and mana in older age. Some of that will be without the sweat of our own brow, some of that will be courtesy of our own savings, some of that will be through a good, stable New Zealand superannuation system. All of these things mean that we get the retirement that we plan for and the retirement that we can aspire to, I think. What we want to avoid mostly in older age is pension poverty.
Susan, that's a good point to bring you in, I think. What do you see as retirement as being in 2020 and on our current path, where are we headed?
I see that it is a time of opportunity and self-knowledge and new learning for many people, but it's also a time of contribution. So the skills and wisdom of older people are needed now more than ever in this COVID world. And if older people can see it more in that sense, that it isn't the end of a period where they've been productive and then they become unproductive, but seeing it as a different kind of productivity, I think everybody in society will benefit.
What do you think is our current trajectory? You talked about some of your concerns in this space already. Where do you see us going?
So, I mean, I'm very much like the others. I think retirement is a trajectory in terms of where we're going, but little is gone of the age where you retire at 65 and there's 10 or 15 years until you pass away. I mean, that timing is becoming more and more. I mean, we're living into our 90s and beyond, and I think there's that gap there, which means that really that sort of pushes out that retirement age. But sure, you might end up moving out of full-time employment and spending your time on something else. And I think that time is here now, and it's going to continue on, that people will continue to work, whether they need it for the means of retirement or to be able to fill their time. But that will continue to happen, and that's still a time of accumulation and also a time of decumulation. And I think, to me, and part of what that I was talking about before is lobbying is, I think there's this, you get to this age where you get this lump sum, but you've still got 30 years between then and your death. Well, what do you do with that lump sum between the time that you retire? You're still working, but you're sort of accumulating and decumulating at the same time. And there's really a lack of product there. And at the same time, when you start getting into aged care, you still need to have money to be able to afford to get through into aged care. So this period, this 20, 30 year period or so, is something we really don't think about in the financial services market, or even just discussion in society. And I think that's something that we need to discuss, is what's going to happen during that period of time as that length even continues to grow.
And what should happen in that period?
Well, I think people need to think of savings as something they need to do their entire life. And we're talking about those people who do participate in KiwiSaver saving 3% or potentially more of their savings. It's just not enough to cover that gap. Secondly, I think New Zealand super is only going to go so far. It's not means tested. It needs to be means tested. Those people, and it needs to be looking after the more vulnerable, where those people who continue to work and save need to be contributing more than that 3% into KiwiSaver. And then beyond that, there needs to be a range of products that allow people to decumulate. So, but there's really no sort of annuity type products in the New Zealand market. So we need to look at building those types of products out.
And when you talk about things like means testing, it's kind of the topic I was raising before, which is we have these kind of instant responses. We need to means test. We need to raise the age. We need to drop the amount that's being paid. All that stuff. People have these views and opinions, but very little of it is backed up with evidence. And my office is going to spend a fair degree of time next year at least providing some if-then information. So if we did that, what would be the outcome? If we did that, what would be the outcome? So I think it's really important to try and keep open minds about changes to the settings until we absolutely understand what happens when you change the settings.
Well, rest assured, no major party is going near it at the moment.
Stability is the biggest thing for everybody. People arrive at retirement in different states. Some have done really well, some of them not so much. Some of them have endured life shocks. There'll be a number of you, I think, in the sector who will know directly of the three key life shocks for the middle class at the moment. I mean, one, of course, is divorce, which cleans everybody out. The other ones are leaky homes and seismic buildings. Many of us have had our savings wrenched out by this. And those life shocks really, of course, affect you down the track. So it's easy to say we should do these things with the settings and we should drop this, raise this, but not until we understand the impact and not until we understand the state of the population arriving at retirement, which we don't.
So are we running out of time for that, though? I mean, between 2015 and 2050, we're going to move it. The number of people over 60 in New Zealand will double. We'll go from 12% of the population to 22% of the population. We've got a big pause on importing population into New Zealand, who are the buyers of assets and the creators of wealth, because the country can't populate itself fast enough because of the way in which family natures have changed. Is this now a rushed discussion? Are we coming to this at a real pace, or has this been thoughtfully thought through? Because I think someone pointed out earlier, this is not a discussion that someone's going to have, not a major party's going to have, because the voting bloc that is affected by this is so significant, it will change the shape of politics.
And that's the contribution I want my office to really spearhead next year, because there just isn't enough coherent and cohesive discussion around this, or information.
Absolutely.
Well, the other part of that is that there's 1.6 trillion Kiwi of assets that have got to move in the next 20 years. And that there's no taxation structure around that in New Zealand. Every other country in the world picks up effectively a death benefit of that transition of wealth. And New Zealanders don't, the government at least, doesn't benefit from that. The next generation does, but I don't know how that helps the country.
Well, we wanted to...
I'd add to what Andrew was saying. Not only will there be 22% of people in the 65 plus bracket, there'll also be another 22 to 25% in 45 to 65-year-old bracket as well, who are getting to that stage of rapidly accumulating, starting to hopefully proactively planning for what that middle later stage in life is. But often many of them are also adult children of parents and looking after their needs in aged care. And that can put an enormous strain on particularly women in the workplace who are, in Australia at least, Carers Australia has stats that 70% of primary carers are women. And many have to reduce hours, have increased absenteeism, presenteeism. So it's impacting their work, which then obviously flows through to their ability to be able to save for retirement as well. So I would be saying that there's a much broader societal need for different pillars of the system to be connecting and talking as well, not just the retirement savings system being separate from ageing workforce, for example. We need to be looking at this in a holistic manner.
I absolutely agree with that.
Susan.
And there are really serious problems for people in that older age group, because our welfare system is so unsatisfactory that those people that have spent time out of the workforce because they're disabled, sick, or simply unemployed, and through the COVID situation, women in particular have been affected, their ability to save enough or to get to their retirement in a sound financial position has been seriously eroded, and we need to pay attention to that group. But there are also intergenerational issues in all of this. So it's all very well for us to focus on those over 65, and comparatively they have done pretty well. But when we look at the younger generation and we see that we've saddled them with student debt, for example, that they're in a position where many of them cannot buy their own homes, many of that generation are looking sideways at those over 65 and asking the question, why is the taxpayer so generous to them?
See, that's an interesting
Because
point.
they're the biggest voting bloc. It's common sense, right?
That's it. I mean, you know, as I'm a political reporter and interviewer, and thus a cynic, and I see three major sacred cows that no major political party in New Zealand is prepared to touch at the moment. And I'm an older millennial, but I'm a millennial nonetheless. And I think about what the current implications of today's policy are going to mean for my generation in 20 years' time. No one's touching housing in any significant way. No one's touching tax reform in any significant way. No one's touching superannuation in any significant way. And it's hard to look at the current policy settings and not imagine that my generation is going to be burdened with significant debt, and at the very least that people who have had the means or the family connections to pour money into the housing market right now will be very well off. But there's going to be a whole slab of New Zealand society that is going to be the opposite. And I just wonder
this
what
is
the
a
implications
very, very dangerous conversation. You have to decide now whether taxation is used as a way to stimulate the economy or a way to redistribute wealth. If you go down the path of using taxation structures as a way to redistribute wealth, that is a slippery slope, and it's a conversation you can have a lot with a lot of states which have kind of done a lot of nothing. So I don't have a strong opinion, although it sounds like I do. But I know there's a lot of experiments that have been done around with it geopolitically. I understand the need for budget repair, and trust me, I spend all my time, not all my time, that's an exaggeration, when I'm not reading the novels of Tom Clancy, I spend the rest of my time thinking about how the macroeconomic settings are going. But achieving budget through repair through the redistribution of wealth is a dangerous, dangerous policy. Be very thoughtful about how that works.
Don't worry, it's not up to me. Rob, what do you think in this?
Well, look, I think you know, from the standpoint of the regulator, what this conversation is pointing to is that a lot of the old certainties about financial products and what they looked like and what they were delivering for, and the standard approach to lots of those have gone. And one of the challenges for the industry and for consumers is that the new certainties haven't arrived in their place. So the challenge for the industry is to think long term and encourage their customers to think long term in terms of their planning. What are you planning for? And it probably won't be an identikit, one-size-fits-all retirement that probably, if you went back 20 years ago, certainly to my parents' generation, you know, there was an expectation of what retirement looked like that you talked about that was largely delivered. It was partly delivered by your employer and it was partly delivered by the government. So I think a real challenge for the industry is in a period of significant uncertainty where some of those key pillars that you talked about really do need looking at and may actually fundamentally change, so the goalposts may have to be shifted. It's to help consumers think, I don't know what I'm planning for, but I need to plan for something. So what's a rational thought process to go through for planning for the future? What risks do I want to mitigate or insure against, and what future am I trying to build for me and my children, if you've got children? So it's a real challenge in that a lot of financial products are long term, and you don't know whether they've really delivered a long way into the product, which is what makes it so difficult to regulate. It makes it difficult for consumers, and it makes it difficult for the industry. So this conversation here points to the fact that a lot of those certainties are gone, and certainly around retirement, what comes in its place is I think, still forming and probably barely off the ground in a lot of countries.
Andrew, I want to bring you in here. We've talked a little bit about financial literacy amongst New Zealanders this morning, and how much we've learned over the past few months about perhaps the level of illiteracy when it comes to products like KiwiSaver. How do we go about improving that so that New Zealanders have options?
But this is a really interesting position, and you've actually picked up on the nuances of what people are saying with this question. I mean, a lot of the work that we do shows that literacy and success in retirement are highly aligned, and education and in this sector and literacy are highly aligned as well. So we know the input drivers to this. So I think if there's something really useful that the government and the networks that are sitting on the table today can do, and when they're thinking about the next, maybe if they're making a 3 to 5 year plan, it's driving up those literacy rates. The problem with economics and economics generally is that it's economics is an imperfect science. We long for it to be algorithmic. It's not. It's at best imperfect, and you can use another bunch of descriptors if you want to. But the role of driving up literacy in the community so that they understand the compounding effects of their actions is possibly the most effective thing we can do in the short term. Now, the recent research we've done, and we've done some with the FSC in New Zealand who've driven this event together, and they've released a couple of reports which I would of course say are well worth reading because we contributed to them. That's the Christine Keeler defence, but the effect of that is really, really important. So one of the things that we tend to say as a group is that literacy is too hard, and that we're going to put it in the 5 to 10 year view, and we're going to start with the 18-year-olds now. I think it's much more complex than that, and we have to start with each of the segments and treat them as different. And to start demographically and say we're going to have a literacy program for the 45-year-olds, a literacy program for the 55-year-olds and the 65-year-olds, and down to the 35-year-olds is really important, because as people understand the consequences of their actions, they start to make better decisions. Recently, I was on I was talking to my old next door neighbour in West Germany, who's a 91-year-old who survived the siege of Berlin. And I said, what do you think? I mean, the German government seems to be handling both the COVID and the economic crisis quite well. And I said, what do you think they're doing? What do you think they're doing? And he said, the first thing that they're doing is they're making sure that people talk to each other and understand the effects of their actions. And then the second thing they're doing is concentrating on making fewer stupid decisions. And I think that's a pretty interesting summary of what we can do as a financial services sector, is help people make fewer dumb decisions. And if we can do that, sorry, I'll stop there. So let me leave it there.
Words to live by.
That's a really interesting segue into the work we're currently doing in trying to reboot the National Strategy for Financial Capability, which sounds terribly flash, and I'd never heard of it either until I took this job up. But it is meant to be a way that the industry, community and government can work together with common messaging and common goals to work on financial capability matters across New Zealand. Now, this is a really important point, and I need the industry to swing in behind us with that, because no one of these three sectors can do it alone. And speaking on behalf of New Zealanders, what we need is utterly consistent messaging out there from all sorts of the sector. This is what compound interest means, this is what this means, that stuff. That's not that hard, but the consistency of messaging is hard. And then we want to find 2 or 3 projects via the strategy every year that will in some way try and shift a dial, and that will be a subject of big discussions around the people involved in the strategy to decide what they are, but really important stuff, because what's hard around all of the space, as we know, is measurability. So everybody has lots and lots of projects, and they fund things and they do this stuff, and nobody has much idea about whether or not they work. That's the hard bit.
Jane, sorry, where does that messaging come from, though? Does it come from home? Does it come from school and the education sector, or does it come from employers to employees?
It comes from all over, because that was the next part I was going to start talking about briefly, which is the work we're doing with Sorted, which is, the hub of financial education information in this country. It is trusted, it is independent, and it utterly relies on the industry as well as everybody else to keep referring to it. So if you work for a bank or a provider or something, there's nothing wrong with you saying, here's what we think, and by the way, go to Sorted and they will correlate what you're saying, generally speaking, and Sorted's not trying to sell you anything. We will be obviously looking for a reasonably significant budget increase to reboot Sorted, because it's desperately needed now. And the Sorted work goes beyond the website, it goes into communities, it goes into workplaces. We are targeting, we've got Sorted at Women rolling out quite soon, and now of course we're in schools, which is the most critical thing from the bottom.
Tell me about the Sorted with Women. What was that?
So the Sorted what?
Did you say Sorted with Women?
sorted women will be coming out shortly.
Yeah, what's that?
Again, the information is all largely the same. It's how you target it. So
Right.
it will be information delivered by women facilitators talking about financial issues from a women's lens, if you like.
Well, see, that's interesting. And Susan, perhaps you can pick up on this because Will mentioned it a little earlier in this session. There are significant discrepancies, aren't there, given our current trajectory and policy settings and everything, in the retirement that some women can expect in the retirement of New Zealand men.
That's absolutely true. And while financial literacy is really, really important, and I don't want to detract from that, it isn't the whole answer. Even to pick up on the annuity question, in New Zealand we don't have an annuities market, and we're not going to have one until the government actually takes it seriously and gets involved. But to get back to the gender issue, women, of course, do not have the same work-life experience as men, and many of them will have 10 to 15 years out of the workforce looking after children or looking after older grandparents, and that then puts them at an incredible disadvantage when retirement savings are tied to paid work. The beauty of New Zealand's superannuation, of course, is that it's a basic income and it doesn't depend on contributions. If you look at a country like Ireland, you actually have to contribute to get your basic pension. So we're extremely fortunate. Women in New Zealand are really, really well served by the basic structure. But nevertheless, there are things in KiwiSaver that have been designed with a male lens. And taking a gender perspective would mean that we would look at things such as access to the subsidies over what time period. When women aren't in the workforce for 40 years, why aren't they entitled to work after 65 and still get the subsidies, for example?
Right. What other settings would you change?
Within KiwiSaver?
Yeah, within KiwiSaver.
Well, we're fortunate in that, unlike Ireland, where you don't have an auto-enrolment till 23 and it doesn't occur after 60, at least we've got 18 to 65. So we've made improvements to KiwiSaver, but the real issue with KiwiSaver is that it is tied to paid work. One of the things that would help women would be the reintroduction of the Kickstart. That was $1,000 that was given to people when they auto-enrolled, and that just helped balance small amounts as they were building up, cushioned them from downturns. So we've lost that. We do have a quite well-designed member tax credit called the government contribution now, and that could be modified again to be more appropriate for women.
Okay, well, I'll bring you in here. From your understanding, do you think that New Zealand super is currently fit for purpose?
I think there's challenges, and I'm going to draw it back out to the more macro initially as well. The COVID-19 experience has been fascinating, where if you put the consumer's hat on and think about their sources of income for retirement, they're all being decimated or have the risk of being decimated into the future. The government support, we can see into the future that the government cannot afford to provide the same subsidies in the future as it has in the past. The sheer workforce dependency ratio dropping, I know Australia's stats and not New Zealand's, my apologies, but it's dropping from about 4.3 to 2.7 over the next 20 years. That's a massive gap in revenue tax, from tax to payments required to support that population. And so the government is going to have to increasingly either increase debt or cut back on age pension, health, so on and so forth. So does that require either a cut in the services that people will receive, or are they going to be paying more themselves? How do they pay more themselves? Do they work longer? But we're seeing a high rate of ageism, whether it's conscious or unconscious, in the workplace at the moment. The over 65 cohort is the fastest growing cohort for workplace participation, unemployment. Part-time women are the fastest growth cohort for employment. So people want to work longer. People need to work longer to supplement their finances for a longer retirement. COVID-19 sadly, that's only going to accelerate ageism in the workplace. And once someone does become redundant, the likelihood of long-term unemployment is much, much higher for someone who's in their 50s, 60s, 70s.
I've had a number of women write to me and said, could you please advocate for the superannuation age to go down? I've been made redundant at 59, 61, 62. My chances of getting employment are pretty low, and I would cheerfully stop work if I could afford to, which I can't, and make way for a younger person to take up a position, you know. It's not going to happen, I think, but it's a compelling argument.
Well, what can we do to make it happen? What can we do to change, whether it's a culture change for employers or for someone else? How can we go about making that change, Andrew?
Well, I mean, I'm not going to comment on it, but it feels like that's just shuffling the deck chairs, right? Because they go from employed to unemployed and they sit on the unemployment benefit. And if they move off the unemployment benefit, they move on to the pension benefit. And it moves the debt from the public sector, which is the unemployment benefit, to the private sector, which is potentially the private sector. So that's kind of ducks and drakes, right? It depends where you put the numbers in the column. So I feel their pain and their emotional pain, and I truly, as a 57-year-old, really get that, because a lot of my friends are facing those kind of issues. But the kind of interesting question that I would potentially ask the panel, and it's not really my job to ask the panel, but where do the thinkers on this panel sit on compulsion? Because even if we educate the hell out of everyone, only 1 in 5 people have the cognitive behaviour to store value for the future. Most people take pleasure now. There's a very, very famous piece of research done in the 1950s by a man called Stanley Marshall about that, was people seek pleasure all the time. And the act of deferring pleasure, which is what savings is not something which comes natural to most humans. We eat sugar, we drink coffee, we smoke cigarettes, we buy whiskey. Just named all my favourite things. But savings is not one of them.
It's a really good question, and it's kind of the difference between Australia and New Zealand in some ways, with the 3-tier system in Australia that has a compulsory element to it, and the 2-tier one that does not. So I think it's a really good debate to have about whether KiwiSaver should be compulsory. Again.
Luckily for me, we don't get a say in these things. But,
but way above our food.
What I would say, if you look at the Australian setup versus the New Zealand setup, is that 2 things. Once you move into compulsion, then your ability to say this is a government scheme and this is not a government scheme, it's a markets-driven scheme, and there's freedom of choice and you should engage and make those decisions, that is compromised. So that there's a rough and a smooth in there. The other point I would say, which again is not really a regulatory comment, is that the thing that we worry slightly about with KiwiSaver is that it's the people that don't have disposable income who are not contributing to KiwiSaver, who are not going to be helped by KiwiSaver, because you don't put money in, you don't get anything out. And I'm not sure where compulsion helps with that, because if you can't afford...
Well, it brings it out of pre-tax dollars, Rob. It's money they never see. So it effectively comes from the government now and comes from and gets paid back to the government in the future. So if you take that kind of Warren Mosler approach to it from the 1970s MMT, is that you see the bill not as a bill but as a credit, a future credit. So it's money that the government spends now that they don't have to spend in future. It means you have to take a 25-year lens, but hey, what are governments for?
Yeah, I get the theory. I just think if you look around New Zealand today, how many people can afford to have that money out of their current income, whether it's voluntary or compulsory. So if you go to compulsion, you've got to think that through, right? Because otherwise you end up abandoning the segment of the population that are going to need most help. So,
or you think about additional mechanisms. Yeah. That's what I mean. It's a good conversation to have and to tease this out, and it's not a conversation we're having sensibly at the moment.
Yes. I mean, apart from compulsion, there's also the ability to be able to reduce tax on long-term savings as well. So, I mean, we're talking about taking money out of someone's pocket, putting in long-term savings. If it's pre-tax, it's much easier to be able to do. And so there's that discussion as well that I think we should be having.
I think that's important, and linking it back to the literacy discussion we had earlier, it's a fantastic program that's been talked about, but when people are struggling today, it's very, very difficult for them to really save for the future, and just trying to make ends meet on current terms. So
it is, right. But that's about 20 to 25% of the population that are in material hardship. and they have a number of access points at the moment for assistance. The cohort we're really interested in is the next 40%, which are the people we discovered in our research at the beginning of the year at lockdown, were the people we're calling heading towards the cliff. So they're younger, they've got high mortgage debt, they've got high consumer debt, maybe one of them's lost their job, maybe other of them's got reduced hours, but bad things are about to happen and they're completely underprepared. Now we've got a survey out in the field right now, right now I think, which we'll be releasing next month, which will say what happened next, which will be interesting. But talking to that 40% is going to be the most crucial challenge for this sector and organisations like mine. The other 20%, the ones at the top, some of whom are extremely wealthy and some of whom are just comfortable. There's a bit of a difference in that 20%, but mostly they can look after themselves. They've got the skills, the talents, the capabilities and access to knowledge. But it's that group in the middle that have not been used to thinking about it, having access to support and access to proper financial planning and thinking, that is going to need the effort.
Andrew?
So, unfortunately, I slightly agree with everyone, which is a difficult spot to be in. I mean, the group, if there's 20% who are facing, 20 to 25% who are facing real financial hardship, then that's a big issue for the country. I haven't looked at the Kiwi data for a while, but the last time I looked at it, a fair chunk of the tax dollars was going towards that 20%, and that's an interesting problem for any economy to face. But you're absolutely right that if you get the people who are facing impending doom and change their trajectory, then you change the economy for the next 25 years, and that's absolutely worth doing. You need both government and private sector will to pull that off.
Yes.
And having that conversation is really important. I guess that's the conversation we're having today. It is the conversation that will change everyone's future for the better. I guess like everyone, I came across this compulsion point when I first started doing economics and looking at what was happening in Singapore post the Second World War, where they forced everyone to save 15% of their savings and stick it in the economic centre there, and the effect that they had on the economy. It took 40 years to have an effect, but it had a monstrous effect. And making that kind of planning is really interesting. What's really interesting to me is that around the world, this has become the Australian solution. It's not really the Australian solution. It was invented by the Americans for the Japanese and the Singaporeans post Second World War. So it's kind of a Milton Friedman's approach to the world, but it's a really interesting challenge about how to get people to make good decisions. We tend to be bad at it as a species, and helping people make smaller, better decisions now is very important. The kind of philosophical perspective on this is, you've seen all those movies about time travel and people travel back in time and they're not allowed to do anything because some small thing they do might change the future. The same is true of the now, right? That's the kind of Martin Heidegger approach, that if you make a small change now, it has a big compounding effect on the future. What are the things that, as a group, we could affect this year, which would change New Zealand's future in 10 years' time? And I guess what's the most important thing we could do now?
That's a great question for you, Susan. What do you think?
Well, can I come back just to the compulsion question? I don't favour compulsion, but the problem is that if you're not in KiwiSaver, you don't get the employer contribution. And if you're not in KiwiSaver, you're likely then to suffer from the wages being lower than they would have been otherwise. And this, of course, affects women. And when we think about women and the COVID situation, I haven't got the figures, but I suspect that a higher proportion of women would have gone for savings suspension during this time. And so that is, again, a gender issue around whether or not we go to compulsion and how we manage that issue, whether we go to total remuneration as a solution, for example, which some people don't favour because it doesn't give a strong enough signal that people should be in. But we have got auto-enrolment, which automatically puts people in and gives them that signal. So that may be enough, and maybe that's one way to go forward.
Andrew, maybe I'll finish the panel in a couple of minutes with that question by posing it to all of the panellists, so perhaps you can all think of an answer to that. What is the one thing we could do now in New Zealand to improve our future? But very quickly, I'll get to a couple of questions from people who are tuning in, watching us online. Jane, why can't, this is a question that's been submitted, why can't you use your trained financial literacy facilitators to help get programs into schools rather than using teachers who may not know about financial literacy themselves?
Good question. We train the teachers. So the teachers absolutely know what to teach by the time they go through our course, and they fold that information through the current work that they're doing in the classroom. The trouble is, as you probably know, there's no way you can have mandatory curriculum activity. It's not the way the education system's structured here, so it's very hard to get things into schools. I knew this in my other life. So training the teachers is the best way to do it. Alongside that, of course, you've got some really interesting and good private sector initiatives going in there, things like Banker, which is talking directly to the kids with their app, and some other works funded by the banks. I used to think that maybe only having one single source of truth going in was the right thing to do, but now I think several sources all saying the same thing is probably the most important bit. But the very short answer to that question is we need the teachers to do it because they're the best people to do it in that system, and they're eminently trainable.
And Rob, is there an opportunity for the industry, in your opinion, to help drive literacy up, as most financial products are pretty complex for the average consumer?
Yeah, more than an opportunity, there's a responsibility there. I mean, as Jane and everyone else is saying, consistency of message and repeating, if I can put it this way, a bunch of really simple messages as often as possible will have a huge impact. And so the providers need to look at this as a long-term gain, and if we can get people to be more confident in their decision making, then benefits will come from that.
Fantastic. All right, we're running out of time very quickly, so I'm going to pose that question to you all once again and give you an opportunity to answer. Will, I'll start with you. What is the one thing we could do in New Zealand today or this year or in the immediate term that would significantly improve the future for ageing New Zealanders?
I think it's linking the mechanisms and the literacy education within the retirement industry with the workplace for our ageing society, so that it continues to contribute when people do want to save more.
Andrew.
So there's two things that I would be doing, and that's not the question, right? You asked me one thing, so once again...
Give us the two, it's fine. Yeah.
Hey, it's us boys from Papakura, right? We never follow the rules. It's a tough place to grow up. So the first is that I think we really need to segment the community, because not all retirement is equal, and treating it as one amorphous mass is a really big mistake. And I think Jane was talking about the different segments. So we have to identify the different need sets very carefully and produce policies for them. And then the second thing is to produce a policy to reduce the number of people who significantly suffer in retirement. And that's kind of a phrase written in the water. But I think that it's really important that we start to look at the things which will really reduce the number of people who are in significant hardship as they replace retirement. And partly, maybe that's just something for New Zealanders to think about. Maybe that's compulsion. Maybe that's tax advantage compulsion. Because if it comes out of your tax bill, then you never see it. I mean, and it's money stored by the government for the government, because it takes away their future bill. So that's potentially what we need to do, is think about a short-term solution and a long-term solution at the same time.
Jane, what do you think?
Engage with us assiduously on the National Strategy for Financial Capability, which we're working on now. Come to us through your industry associations, come to us directly if you can offer specific research or, frankly, financial help, doesn't really matter. But allow us to collectively next year say government, industry, community, all say here's what the goals are, here's who we are talking to, and here this year are the 3 projects we're all going to collectively work on to shift a dial somewhere.
Rob.
Yeah, I'm with Jane. I think it's public sector and private sector combining to give really consistent, understandable messaging to people about planning for their future. And I think if we're all speaking from the same hymn sheet, if you like, it will work.
Susan.
The profile of retirement issues needs to be raised. In this election, we've hardly heard anything about it. We're halfway through the baby boom retirement. By 2030, the oldest baby boomer is turning 85, swelling the demands on aged care. It's time that we had a proper national discussion.
Ryan.
I'm probably more with Andrew. I think there's a number of things to do here. I think compulsion is definitely one of those things. I think making it easy for people to save through tax. I think through tax relief. Plus, I mean, I think as a country, we're generally undertaxed. I know a lot of people probably will rue me saying that, and I think we need to start thinking
and here's the reason you had your red tie on.
I think we need to start thinking about taking care of the vulnerable, and those people who can take care of themselves should take care of themselves, but we need to make it easy to do so. We're still sending a lot of dollars out internationally. KiwiSaver's investing very little in New Zealand markets. We need to see KiwiSaver investing more back into the country and into infrastructure within the country, which will create jobs, etc. So, I think there's quite a number of things that we can do on this front.
All right. Hey, thank you so much, all of you, for your time and insights this morning. This is such an important conversation, and we really appreciate you being here with us. Will Burkett, Andrew Inwood, Ryan Bessemer, Susan St John, Rob Everett, and Jane Wrightson, tēnā koutou, ngā mihi kia koutou. Thank you very much for your time.
Thank you very much.
Wow, there was some great advice there and certainly got me thinking about my future financial security. Thank you to our panel of experts and for their expertise and analysis of the future of retirement. I'd also like to take a moment to thank Jack Tame. He's leaving us today, but it's been a pleasure to have him as part of the crew in the set. I understand Jack is travelling to America to cover the US elections, so good luck with that.